Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to show you the last video of a series of 4 regarding capital allocation and with specific focus on dividends and share repurchases. It's important from these 3 videos and this 4th one to understand the way that dividend payment affects investors. Some investors are focused only on dividend income. There are a few drawbacks, let's say, in that strategy that I see, and that with all these 4 videos, I think we will understand. Of course, it has advantages as well, but what I want to lay down here in this 4 series is an understanding of at least what I see as all the picture, let's say, in terms of dividend payments from the company perspective and from the shareholders' perspective. So let's get to it. If, for example, I give you this statement that could come from a company saying, we have a dividend policy to pay 33% of profits in dividends every year. Our track record is pristine. We have been paying a dividend every quarter over the past 25 years. So this, I think, most investors will see that in a positive light. But then if I give you another statement or hypothetical statement from a company saying exactly the same, but changing, instead of paying a dividend, the company is now going to acquire other companies. Of course, this, in my view, I think, and in most investors' view, wouldn't be a positive sign. I see these 2 statements as 2 different sides of the same coin. In both cases, management is not revisiting frequently the capital allocation decision process. And if you're not revisiting frequently that decision-making process, then for sure you're not going to have maximization in mind. So this is one clue that I normally see in managers. When they are paying a dividend for a long time, they have been increasing that dividend. There are special cases which show that, that's the only way to go. But some other cases, it's a sign that managers are not really focused on maximization of value. One company I want to show you as an example is Berkshire Hathaway, which is, as you may know, a company that I like and I have been an investor for many years. And they do exactly that. If you see, most companies pay consistent dividends, generally trying to increase them annually and cutting them very reluctantly. This is what Mr. Buffett says in the same shareholder letter that we analyzed in video number 1 and video number 2. And then he goes on and says, at Berkshire, however, we have consistently followed a different approach that we know has been sensible and that we hope has been made understandable by the paragraphs you have just read. So he is referring to the example that we saw in video 1 and 2. He says, we will stick to this policy as long as we believe our assumptions about the book value build-up and the market price premium seem reasonable. If the prospects for either factor change materially for the worse, we will re-examine our actions. So the key word of the whole paragraph here is we will re-examine. So they are constantly re-examining whether this equation that Mr. Buffett showed us and we analyzed in video 1 is true or not. And the moment that changes, they will change their mind. So this is what I want to see, I like to see in managers. And also here from Munger in 2014 shareholders letter, the vice chairman's thoughts, and he addressed that to shareholders of Berkshire Hathaway. He was talking about the systems and policies of Berkshire under Buffett. And number 8, he says, Berkshire would not pay dividends so long as more than $1 of market value for shareholders was being created by each dollar of retained earnings. So the key word here is, again, so long as, meaning they are revisiting this frequently. And here you can see also that he's thinking about value creation. As long as whatever they reinvest in the company creates value for shareholders, meaning they can invest it at a higher rate of return than what the cost of capital is, then they will keep doing what they've been doing. Then when you have some companies are paying a dividend, and that attracts a certain type of shareholders. This type of shareholders are dividend investors, those that want to receive funds on a regular basis. They also attract a certain type of reputation. These companies are called Dividend Aristocrats, those that have been paying a dividend for 25 years or more and increasing them. Of course, this to me clashes with maximization of shareholder value, because if you want to maximize value, you have to revisit that frequently. And of course, a policy of dividend continuity and growth, which is fixed, cannot be revisited frequently. There is a risk, in my view, to those shareholders that invest in companies just for the sake of receiving a dividend, that managers are not thinking about maximization of shareholder value. From the investor perspective, of course, is a different story, because the dividend investor is normally needing a reliable flow of funds because they are in a retirement stage. They are withdrawing funds from their investments. So even if the sell-off approach is better, we learned in video number 1 and video number 2 that the sell-off is only better when you can sell your shares at a good price. And of course, if you are a person that needs every quarter or every month some money, you don't want to expose yourself to the price of the stock getting too depressed. So then you, of course, are attracted to companies that pay dividend because the volatility risk, let's say, is reduced. From the perspective of the net saver investor, on the other hand, this is a person that is in accumulation period, meaning you are a net buyer of shares. Any dividends that you receive will be probably reinvested. So remember that when you reinvest a dividend, you have this round trip cost that we saw in video number 3, and it's shown here in this little graph. And also you want a company that takes maximization of value in mind for the long run. So anytime that company is going to pay a dividend or share repurchases, will have to go through whether it creates or destroys value, in the same way that Charlie Munger explained the Berkshire system and the Buffett. When I was researching, I came across this article that I think it's interesting to show just quickly. They were talking about dividend investing for beginners, and they talked about what dividend income is. They also talked about dividend investing for long-term portfolios, and then they said how dividend reinvestment boosts your returns. So they were saying that when you reinvest your dividends, you can buy more shares, of course, and that will help the compounding effect of the investment. They made an example, and they said in the last 20 years, the Standard & Poor's gained 4.2% per year. But then they said if you reinvested the dividend, you would have done 6.2% per year. So they were assuming an average yield of 2%. But remember, again, the return trip cost of dividend reinvesting. So in this case, this investor is only getting 68% of what they reinvest. So that means that they would not get the 2%. The only way for the investor to really make this extra 2% is for the company to avoid paying a dividend and reinvest all that money back into the business. And then they also talk about the tax benefits of dividend investing. And we saw, remember this slide in video number 3, if you haven't, go and check it please, that dividends are at a tax disadvantage to the sell-off alternative. So between the dividends and sell-off, the sell-off alternative is a better alternative in terms of a tax minimization. And now let's summarize with the main takeaways of this whole series, let's say. So the main one to me is, first, when a company can reinvest at a return higher than cost of capital, then the dividend is not preferable. We saw that in video 1 and 2 when we explained why the sell-off alternative is better. The second takeaway would be that if the company cannot reinvest at a higher rate than the cost of capital, then of course it's better off distributing. And when distributing, there are two options, either the dividends or the repurchases. And we know that dividends, if they distribute dividends, is neutral to value, because the money that they distribute is not going to create any value, but at least it's not going to destroy value if they kept reinvesting them. And in terms of repurchases, it can create value if they buy the stock at a lower price than fair value, and it can also destroy value if it is done at a higher price than fair value. So one thing here that I want to note is that there is a connection between this, number 3 here, the repurchases, and here. There's still an avenue to reinvest back in the business via repurchasing stock when it can create value, while that avenue is not available when you're paying a dividend. And then number 4 is there are a few issues of payment of dividend payment. One of them is the round trip cost that we saw. The second is the tax disadvantage. The third one is that forced distribution for shareholders. So that reputation that they gain by being a dividend paying company or like an aristocrat, that of course restricts the possibilities of creating value for companies, I think, or maybe sometimes obliges them to destroy value. And then this aura that businesses that pay dividends have of being conservative, we have made it clear, I think, in these 4 videos that it's not necessarily the case, and in fact, sometimes it's the opposite. When you have a company that pays the dividend that has a reputation of being a dividend payer, it is most probably not handling your funds in a conservative way. To me, handling your funds in a conservative way means that they are trying to maximize value and assess the risks and the opportunities every single moment. So on the 5th takeaway, probably is the summary of the whole thing, is that the decision whether to distribute should be done the same way that all other investment decisions. So when companies decide, okay, how am I going to use the funds? Paying a dividend should be seen in the same light as making an acquisition or reducing debt or investing in the business or retaining cash, whatever. All of it has to be done in the same way, with maximization of value in the long term for shareholders in mind. So that's the end of the whole series. I hope that you like this video, please, or this series of videos. If you like it, please give it a like. If you haven't seen number 1, 2, or 3 videos, go and have a look, because there's lots of analysis and lots of things that I've just said in this video that are based on what we saw in the last 3 videos. So thanks very much for watching. I hope you liked it. Give it a like, please, and if you like. And I'll see you soon for another video. Bye bye.